Joining me up here today, we have David Franklyn, co-head of funds management at Argonaut. We have Warwick Grigor, chairman at Far East Capital, and James Champion de Crespigny, managing director and CEO at Catalyst Metals. So thanks for joining us here today. And to kick things off, maybe you can just do a quick introduction in case the audience doesn't know anything or know who you are. So James, if you want to kick us off.
Right. Hopefully you can hear me.
Yeah.
I suppose I'll go first. Catalyst Metals is an ASX-listed gold mining company. We're operating in the Plutonic Gold Belt up in between Newman and Meekatharra. We did 2 acquisitions earlier this year to consolidate that belt, and probably more well known in Bendigo, and own 75-kilometre belt immediately north of Bendigo, and some high-grade exploration down there. It's a company that's been around for about 10 years, and I've been the chief executive for the last year, but been on the board for the last 2. So that's probably a background of Catalyst and my role with it.
Thank you. David Franklyn from Argonaut Funds Management. So I'm co-head of funds management with Ben Clifford. So I run the Natural Resources Fund and Ben runs the Gold Fund, but we kind of support each other across that. So I'll be stepping in today and talking gold.
I'm Warwick Grigor. I've been a gold specialist since the early 1980s. Dabble in a few other things here and there, but basically I'm a mining analyst with a lot of corporate and stockbroking experience, and I'm happy to share the knowledge base with you.
Absolutely. So as with previous panels, we'll try to keep it fairly informal and keep it open for discussion. So if at any point you have a question, looking at you, Alberto, you can throw your hand up and ask one to the panel. But to kick things off, I thought we could just look at, how is the current macroeconomic and geopolitical environment impacting the gold and precious metals market? So, looking at pricing, as we sort of start to round out the year, what are you seeing right now? So maybe we can start from the far end if you want.
As far as gold is concerned, I've written a few pieces over the last couple of weeks saying, gold is the effervescent commodity that are perfect for it's perfect for junior companies because of the ease in mining and selling. And when I was at Diggers and Dealers back in August, I was quite surprised how many people had a downer on gold. Everyone wanted lithium. Everyone wanted these exotics. And it didn't make sense to me, and it doesn't make sense today. A lot of companies out there trying to raise money for, be it lithium, be it rare earths, whatever. But the one sector which has performed very strongly over the last several months in particular has been gold. And with the movements in gold in the last week, it's not going away. And I think there's going to be a resurgence of interest in gold stories because they are just so amenable to junior companies.
Okay. Yeah. Look, I think if you look at gold, really over the last couple of years, in an environment where you've had interest rates go from 0% to 5%, and the fact that gold's actually held up and it's now approaching, $2,000 an ounce, and in Australian dollar terms, about $3,000 an ounce, it's a phenomenal performance because higher interest rates should actually have a negative impact on the gold price. And I think the reason that it's performed well, and I think it will continue to perform well, is the world is a dangerous place. We've got economically a lot of risk associated with that increase in interest rates. It puts pressure on the financial system. You've got Ukraine and Russia. You've got what's happened in Israel recently. You've got tensions all around the world. So gold as a store of value is increasingly in the limelight, and I think it's well placed to continue to perform.
Catalyst as a producer, I'm not sure we can add really much more to what Warwick and David have said. We're about producing gold, not forecasting where the gold price is going to go. And so, for us, while we provide long-term upside to our investors of gold, we're concentrating particularly at Plutonic on the day-to-day. So, really we do hedge in the short term, and we like hedging in the short term so we can protect that long-term, quite large resource base that we've got there. So I think probably maybe just a bit of a different focus on gold from our side than the perhaps much smarter, cleverer way that Warwick and David are able to look at it.
We'll definitely get into some of the kind of investment topics that are relevant more for the that sector in a bit. But I thought we could just look at, central bank purchasing has been a big topic of conversation over the past couple of months in terms of the gold price. So, how much is that impacting the markets and where it goes?
I'll go first. It's really been the fundamental factor over the last 12 months. I think it's if it's not at all-time highs, it's very close to it. And I think that reflects what I was saying before about the uncertainty in the world. Because if you look at where the buying's coming from, it's coming from China and Russia and Uzbekistan and Turkey, countries that perhaps don't want to have all their assets in US dollars or in Western currencies.
Well, central banks buying gold makes sense because of the stability that gold offers. You've got countries such as China and Russia and probably other rogue states that are buying because they don't want to rely on the US dollar. That makes sense too. If you go back 10 or 20 years, the young bankers would say, well, gold is a barbarian relic of times gone by. But it's much less able to be manipulated in the long term because there are so many vested interests in it. One of the issues with gold over the last 30 years, for example, is the world money supply keeps growing, but the amount of gold coming into the market each year is maybe 1 or 1.5% increase each year. Some people look elsewhere to make money, people who want to move a lot of money around because the proportion of value in our currency, in our economy for gold is actually shrinking every year. So it's becoming less important in some ways, but then it's more manageable by central banks, and it's not a big risk for them to go and buy gold. So it's going to keep happening.
Yeah, only a small comment to add. I think it's fascinating. In the late 90s, all central banks selling gold and thinking gold's a thing of the past. And yet, really that's what David and Warwick, I think, are saying, is that yet it's come back in such volumes. If we've lasted 40, 50 years and that's been the trend, going back to Warwick's earlier comment, it's not going anywhere. Gold, it's going to be the same conversation probably in another 30 or 40 years' time at some other panel. So I think gold's around to stay, whether it's central banks being in and out of the market as they have been last 30, 40 years.
Yeah, in terms of investors and what they should be looking for from gold, it's exactly what David was saying. It's the stability of the gold. You've had lithium prices, rare earth prices, a lot of other commodities. They've collapsed by 50% in the last 6 months or 9 months. But there's no way I can see that happening with gold. You can actually sleep with gold in your portfolio. And as I said, the best performing companies in a portfolio of 150 stocks I look at are actually gold producers. Now, I wish I'd had all my money in Emerald Resources 2 years ago. I'll be a lot wealthier than I am today.
Can I ask, Warwick, you've been around doing this longer. In the 80s, there was a serious drop in the gold price. Was probably the last time there was a significant one. In 2013, there was $100, $200 drop, but it certainly wasn't that size as it was in the 80s. Can it ever go back to what it was in the 80s, or that very much is a thing of the past?
No, that's a thing of the past. There are too many vested interests in gold to allow it to collapse. There are too many companies that are looking to buy gold on any weakness. If you go back to the 80s, you said that you were a forward seller of gold. Now, to put that in historical perspective, back in the 80s, with especially your father I assume he was your father, he was a big advocate of forward selling, because you could sell spot deferred today and you'd be getting 10 or 12% interest on your holdings in the bank. We had high interest rates then. That encouraged a lot of forward selling of gold, front-end loading of gold. And you know, some people took issue with me because they're saying that, well, gold supply doesn't change, but it does change if you sell it forward. You saturate the demand on that week or month or day. That made a lot of sense. But with interest rates down where they are now, it doesn't make sense to sell forward other than a very defensive measure. It's not a way to make easy money like it was when interest rates at 10 or 12%. So, yeah, hedging is a legitimate strategy, but you're at far more risk of volatility from exchange rates than the gold price. And, you know, I think, as we've been saying, the stability of gold is why you have gold. It's not going to disappear overnight. It's not quite as good as real estate, but then again, real estate can fall 30% overnight if you have the recession we had to have that Paul Keating gave us. You know, the more the gold price falls, once you get through the initial wave of selling, that's when the bargain hunters will come back. So you'll get volatility, but that's normal.
Do we have any questions about these kind of broader topics before we look more at investment into the industry? Yeah, can we get a...
I just read that China now owns the most amount of gold compared to all the other nations. And that's because they've accumulated, what's the word? I don't know what the word is, maybe underhandedly or privately or unknowingly. So how are they doing that? And what do you think China is thinking or potentially thinking?
Well, one example is they'll go and buy gold mines. You've got an example, Buriticá in Colombia. They paid 1.4 billion Canadian for 65% a few years ago. They've expanded that production from 250,000 ounces per annum to close to 400,000 ounces. So that gold will go straight into Chinese coffers. It's Zijin mining. That's an example. Rather than just buy on the open market, they'd actually like to control the operating gold mines. And like every other commodity in the world that they want, they like to go to the source of the gold rather than just buying markets. And so you can't really say that's underhand unless they're underreporting what they're pulling out of a country. But I think, you know, there's audit processes to protect that. But sure, if they want to buy gold, the last thing they'd want is to have too many people knowing they're buying gold if that leads to front running of the gold price. So they need to be astute traders. Sometimes they need to be selling just to hose down the gold price. So a bit of stealth, yeah, that makes sense.
I think if you look at the reported gold bullion stores globally, I think the US still holds quite a bit more than China. But as you're saying, maybe it's not all reported. But I think the reason China is looking to build up its gold reserves is really the reason that people have owned gold for centuries, and that is that it's a store of value. It's not linked to a financial system or a specific currency, and I think that's its real value.
So let's look at investment into the junior end of the market here. So, you know, looking at what brings investors in, what should people be looking for in an investment, and from the corporate side, what do you hear from investors in terms of appetite and interest?
I suppose from the corporate side, you really want to be a producer at this stage in the cycle. In fact, I mean, David and Warwick will know far better than I, but this has really been compared to sort of 2013. And then before then, probably early 2000, 2001, 99, that it really is very, very difficult if you don't have cash flow. And really, Catalyst's journey has been about getting your hands on cash flows so you're not at the mercy of the market. We haven't been much more creative than that in our approach. But really, it's for times like this where things are very, very difficult if you've got to raise money. So.
Yeah, look, I think the market rally in gold and gold shares has been very focused, excuse me, on the producers rather than the junior end. But so if you're a junior and you want to get support, one, you need to be in a good location, so typically Australia and preferably Western Australia. Two, you need scale. So the ability of someone to raise enough money to build a small mine and produce 100,000 ounces for 5 years, I think that's getting very, very difficult. You've got to have a bigger scale project with a longer mine life. And grade, I think, is also looking more important, where people are saying if it's very low grade, short mine life, it becomes difficult. So it's the quality of the project, the ability to raise capital, so what's the capex of getting it up and running, and management. Management's critical, and you're seeing that now. Juniors that have management teams that the institutions are prepared to back get their projects up, whereas a lot of others don't.
Well, the most important thing that you mentioned then was grade. Grade is king. We've got a lot of Western Australian projects in particular that are talking about 1 gram per tonne. Now, if you get your kriging model wrong, if you overestimate your gold content by 10%, that could be your entire profit margin. Have a look at the disaster with Dalgaranga. Some companies can do it really well, and that refers to the management. Anyone who's been taught by Nick Giorgetta, for example, you can just bank on them as being the best management in the system. The good thing about gold is that every gold deposit is different. It's not generic like coal or iron ore where you fit into a small band of parameters. Gold can vary in grade, it can vary in tonnage, in geology. You can have all different levels of management. And I think the onus is on anyone who wants to invest in the gold sector to have a checklist of the various aspects. I would think at the moment, I'll give you an example of something which people are queuing up to put money in. It's 24 grams per tonne recovered. It's in what's generally perceived as a higher risk country, Colombia in South America. Yet there are two groups of people when they look at Colombia. Those people who have been there and love it, and those people who haven't been there and just think of Pablo Escobar. What little companies looking for, juniors, they're not looking for economies of scale, they're looking for profit margins. And if you've got a 24 gram per tonne ore body, mining 24 grams and recovering it, you don't need a big mine. The profit margin can be enormous. And the company that I wrote up on the weekend is exactly that position. They haven't got a drill hole. So they've just started developing on the ore. And some people call it high risk, but if they've been pouring gold and then they're mining it, it's going to give you a lot more information than 50 or 100 drill holes where you've got a little narrow core and you're trying to interpret what that means. So risk factor, there's nothing that's risk-free. You've got country risk. Western Australia's got a lot of geopolitical risk, in my opinion. If you have a look at that Heritage Act and where land rights are going and things like that, people have been telling me Colombia is lower geopolitical risk than Western Australia, which I can't argue with. So the thing is, you need to do your homework. There are many aspects to consider, but in that mix, you will find something that suits your risk profile and your budget. And the other thing is, in terms of gold, if you're looking for an investment in the gold sector, people have called me a gold bull over the years, but the reality is you want a gold company that's expanding production, whether it's going from a resource into production for the first time and you're confident they've done the numbers right, or whether it's just expanding the existing operation. The steady state gold producers don't excite me at all. You want growth, because if you've got no growth, you've got a shrinking asset, diminishing asset over time, and it's just a gold price play. But you want to get more than just a gold price play. You want something that might be worth $5 an acre today, and with successful explorations, worth $1 million an acre. That's the sort of thing you want. You want leverage, not just the stability of gold, but you want the leverage from the business venture you're going into.
Can I ask, Warwick, with the juniors suffering, there's been a lot of M&A activity in that mid-cap space. Has it been good activity to grow that growth production profile, in your opinion, or not so good?
Yeah, there's companies, the really big companies like to take out, Newmonts and B5s and things like that. They seem to get turned on by getting bigger and bigger and bigger. The mid-caps, I think that there's a lot of consolidation, takeover opportunities. Quite often the successful producers can see when another company is messing it up and they could do it better. I think there's going to be more consolidation. I think on the junior end, there's going to be a lot of companies that will fail because they've gone off half-cocked. They haven't got what it takes. They haven't got the sex appeal to attract more money, and money is very hard to find at the moment. That Colombian situation I was talking about, it will, in 6 months' time, they reckon that they'll be able to make $2 million a month positive cash flow from the investment from this point of another 1 or 2 million. Now, that gives a company like that enormous leverage because they don't have to go back to the stock market. They'll find opportunities to spend that money, sure, but there's going to be a lot of rationalisation down the bottom end. A lot of companies are going to fail. And when I say a lot, I could easily see 50 or 100 companies going to the wall.
Any questions from the audience before we go on?
Thanks, guys. I guess there's a lot of discussion on the equity side, but what's your view on gold bullion and actually buying physical gold, bullion point of view, and compare that? And I know there's various graphs that show you, and Warwick, I think you touched on this, investing in a high growth, small cap gold company might give you better bang for your buck than gold bullion. But what's your investment on view on gold bullion?
I might kick off. In our gold fund, we can actually own physical gold. So we own through physical backed ETFs, passive investments. We own some gold and some silver, physical. It's an unleveraged way to play the commodity. So it's going to move in line, obviously, with commodity price rather than a multiple of that. So we see it as part of a portfolio. It's a different kind of investment to an equities investment, but it makes sense as part of an overall portfolio. Yeah. At the moment, it's about 10% in physical gold and silver, but it really varies depending on the view that we take on the market.
What's your view on silver as an alternative, or perhaps a more levered play if the gold price does go for a run?
It's a good question. I think silver looks pretty interesting. I'm probably not the right guy to ask that question. It's probably Ben Clifford, who's our resident expert, rather than myself. But from what I can see, silver is a much smaller market, much more volatile market, also has a big industrial demand base and a link into energy transition to an extent. So it does seem to be a more volatile, more leveraged play. But happy to hear other views.
But the leverage is what would appeal to me, because when the Americans decide to go for silver, they buy with their ears pinned back. And if you get it right, well, leverage is what you want to, which gives you more than just a store of value.
Okay, so I mean, my last question was really just kind of looking at the ESG aspects. So you know, a lot of the discussions that we have at these events are looking at investment within that ESG framework, and so you know, how does investment towards gold or the precious metals how do you factor in that ESG component, I suppose?
I'm happy to kick that one off first. Again, I was here last year, and when we were talking about gold, the question was, what is it good for? You know, why do you need it in a world of ESG, and you know, why are you digging this stuff up? And I think 12 months later, you go, thank God we've got gold, right? Because it does have a position in what is a dangerous world. So I think it gets a tick there. But the other aspect is if you can have an ESG element to your mine, on top of that, it gets rewarded. And the perfect example is Bellevue. You know, Bellevue on a production versus market cap or enterprise value is now really priced at the very top end of the Australian gold sector. And that's partly to do with its grade. But I think it's also adopted a very ESG focus, and the market has rewarded that. So I think that's a positive sign.
I mean, I'm just interested in your comment there, David, on that. I mean, Capricorn, Mark Clark, and what he's done is arguably probably the best team we've ever produced as a country. Yet their credentials probably not being quite so good on the ESG side, as far as I understand it. Do you find it's, you know, is Bellevue just ESG related, do you think, relative to, say, Mark?
Well, I think it hasn't hurt. So the way I mean, you're right. If you look at who's rated the highest, it's Capricorn, and that's been, you know, from a history of performance. But if you look at Bellevue relative to though, they're closer than you'd think, and particularly as it's going through sort of the commissioning stage, which is a higher risk stage, right? So it's a big call. And I think it comes down to grade and the ESG element and the renewable component to it and all that, which is interesting.
I can only say that because we're hydropower and gas power, so we don't talk about it. Mate, we're hopefully putting our money where our mouth is rather than... Anyway, Warwick?
Well, I'm a bit old school. I'm an environmentalist, always have been since I was a boy. I wanted to be an ornithologist before I discovered the stock market. There are a lot of good aspects about ESG that should be incorporated in our lives generally. I tend to think that it's a bit of a distraction by making that as prominent as it is and looking for brownie points for ESG. So I'm not as keen on the amount of money that's spent just boasting about ESG. But, you know, anything like a bulk mining commodity like iron ore or coal, they're going to have a lot of carbon emissions. They're not going to be very ESG friendly. As David said, Bellevue's got to be one of the best. Again, we're getting back to high grade. We're getting to underground. They only move the smallest amount of dirt possible to get that gold out. So if you're worried about ESG, go for that. But you know, there's no substitute just for being good, responsible management. Call it what you want. A good manager will have that in his psyche anyway.
Anything else from our audience before we wrap it up? All right, so I thought we could just close with some, you know, closing thoughts from the panelists on, you know, looking at the year ahead. How do you see kind of the industry working itself out, I suppose?
I'll go first. I suppose from our side of things, it's volatility in the gold price makes it extremely difficult to run a gold company in this environment. So how do you look after the short term so you don't hurt the long term? And you know, as a company, we've been able to graduate from being an explorer to a producer. I don't think that's necessarily the easiest thing to do. You've got to get on to the next challenge, which is trying to manage a growing workforce that's chomping at the bit to really push the boundaries, and that's what we've tried to do in our graduation from explorer to producer, and hopefully we can manage gold price volatility in a challenging labour market, inflation market, and the rest of it. So got our work cut out for us there, but we like where we're heading. So as a company, we're very, very focused on our feet in the short term.
Sounds good.
Yeah, I'll talk more about the commodity, and I think you have to be optimistic, just given the state the world's in. You've got wars, you've got potential recession down the track, potentially stagflation. You've got a lot of debt out there and the implications that has for financial systems. So hopefully we get through it and gold actually eases off and the world's a good place. But I think you have to have some gold or some gold equities in your portfolio, because the world is a dangerous place.
A lot of people have lost a lot of money in the last 12 months playing non-gold stocks. Investing in the stock market is a very emotional business, and often the number one criteria is, can a company create FOMO to make the raging masses go out and buy their stock? But what goes up goes down. What gold has done for investors is created a stability that's seen through all those emotional movements. And I think that when people start to come back to the stock market, when they've stopped licking their wounds, and if they've got any money left, it's going to be a lot easier to go into something where you can actually do proper analysis of, and you can understand what you're dealing with. How many people really understand the economics of rare earths and the metallurgy and everything else? Investing in the stock market, at best it's gambling. It's a casino, because there's a shortage of people telling the truth. At least with gold, you know the questions to ask, you know the parameters to look at, and you can work out for yourself whether something's going to make money or not. Of course, with the caveat that what the company's telling you is truthful. But just like holding gold is a defensive investment in your overall wealth, holding gold stocks provides you stability in a market which is very volatile. And I think that there's always going to be a market for good quality gold stocks and emerging gold stocks that give leverage to exploration success. So go gold.
All right. That's a great way to end it off. Go gold. So I want to thank our panelists for joining us.